So back in part 1 of this series, I told you that businesses will typically sell for anywhere between 2 to 4 times earnings. Now today, I'm going to show you exactly where that number comes from. Because every serious buyer who looks at your business, from a first-time entrepreneur through to a seasoned private equity firm, is going through the same thought process. Most brokers never really explain it to the sellers, but once you understand how buyers actually think about your business and understand why they offer what they offer, you're in a better place to negotiate with them. This is part 4, the final part in my series on business valuation. In parts 1 through 3, we covered the 3 standard approaches to valuation: the market approach, the income approach, and the asset approach. If you haven't seen those yet, the links are in the description below. Now today, we're covering what I call the returns approach. It's the method that most brokers won't walk you through, but it's one that I use in almost every valuation I do because it reflects actually how buyers will think about things. I'm Ed. I'm a business broker and the founder of Sundance Financial. We help small business owners sell their companies all over the US. Now let's get into it. So here's the thing about the first 3 approaches. They're all trying to answer the seller's question, or your question, which is really, what is my business worth? The returns approach flips that around and asks instead what the buyer is more likely to be asking, which is really, at what price can I purchase this business and still earn a reasonable return given the risk that I have to take? Because at the end of the day, buying a business is really just an investment. If we step back and think about the buyer's alternatives for a second, they could put their money in something like the stock market, for example, the S&P 500, and earn 8 to 10% per year without thinking too much. If instead, we're going to be asking them to take that same amount of money and put it into buying your business instead, to take on the risk and probably work in the business full time, they'll need a return that's a lot better than that in order to make it worth their while. So the first thing that the buyer will often do is to start with the return that they need and then work backwards towards the price that they can pay to get that return. Now, before we get too deep into the mechanics, let me give you an overview of what we're actually doing here. What we want to do in the returns method is to put ourselves in the buyer's shoes and simulate the investment from their perspective. To put that simply, there's a price that a buyer will pay on day 1 for the business. That's essentially what they pay to you. They then collect the business's cash flows every year in which they earn it, and then finally, at some point down the road, they probably sell it and earn a bit of cash then too. That's the entire life cycle of the investment. Money goes out at the start, then hopefully money comes in while they own the business, and then money comes in again once they sell it. Once we've completed that simulation, we can simply find the price at which buying your business earns the buyer a reasonable return on their investment. Now, one thing I want to note up front, the output of this exercise we're about to do isn't necessarily to arrive at a single number. Instead, I like to think of it as a set of bookends. There's a price at the top end that works for a buyer who sees a stable, lower risk business, and then another price at the bottom end that the buyer who sees a riskier one might still be willing to accept. These bookends tell us the range at which a rational buyer can actually purchase your business and still make a reasonable return on their investment. So getting into the nitty-gritty. To run the simulation, we essentially make a few simplifying assumptions. Now, we don't need to make these assumptions, but for the purpose of this explanation, I'm going to make it so that we can simplify the entire exercise. The first assumption is that the buyer holds the business for 5 years. Now, this assumption is not because every single buyer necessarily sells their business after 5 years. It's simply a standard assumption and one that's very typical in industries like private equity that give us a defined window over which we can simulate the investment. The second assumption is that earnings will stay flat. We take the business's SDE and we hold it constant over the buyer's investment period. The reason we do this is because a buyer is very likely going to take a conservative approach when valuing your business. They may not want to pay you for the growth that is not necessarily locked in, or the growth that they have to go out and create. Now, obviously, there are many situations where applying a growth rate to the business's SDE over the investment period makes a lot of sense. But again, for the purpose of keeping this video really simple, we're just going to assume that it stays flat. The third assumption is that the buyer sells the business at the end of their investment period for the same multiple of earnings at which they purchased it. If they purchased it for 3 times SDE, they also sell it for 3 times SDE. Since we're assuming that the earnings are staying constant as well, this essentially means that the purchase price that they pay and the exit price that they receive when they sell it are the same. Again, this is a deliberately conservative assumption. We're not making any judgment about appreciation in the valuation multiple over the holding period. Fourth and finally, let's assume that the buyer pays for the business in cash. Now that means that they don't go out to borrow any money in order to finance the purchase. Obviously, in the real world, most buyers will finance a chunk of the purchase price through an SBA loan or other sort of loan. But keeping the model all cash for now allows us to again keep it simple, and it lets us look at the return that the business itself generates before any financing decisions come into play. Now, are these assumptions conservative? They absolutely are, but remember whose shoes that we're stepping into. The buyer isn't trying to model a dream scenario. They're really just asking, if I buy this business and nothing improves, do I still earn a reasonable return at my purchase price? If the answer is yes, they can do the deal with a bit more confidence, and then anything they improve in the business is upside on top of that. One final adjustment before we run the numbers, the buyer doesn't actually keep every dollar of SDE that the business generates. Some of it has to be reinvested back into the business at the end of each year or during each year in order to do things like replace equipment as they wear out. For example, things like repairing trucks, mowers, replacing machinery, etc. Now that reinvestment has a specific name. It's called capex, which is short for capital expenditure. So the way we can think about annual cash flow to the buyer is actually it's equal to approximately SDE minus your annual capex. So now that we've established all that, let's bring back our landscaping company that we've talked about from parts 1 through to 3. Recall that this landscaping company generates about $300,000 annually in SDE. Let's also assume that this business spends about $20,000 per year on capex in order to replace worn equipment. $300,000 minus $20,000 gives us about $280,000 of annual cash flow that accrues to the buyer. Now let me show you what a very simplified version of this simulation looks like when a buyer builds it out. You can see here that there's a line for SDE, there's the capex line we spoke about earlier, and a line capturing the purchase and sale price of the business. You can see that the buyer pays $700,000 on day 1, they collect $280,000 per year while they own the business, and then at the end of year 5, they sell it again for $700,000, which is the same as what they paid for. If we drop these cash flows into Excel and we ask it to calculate the annual return on investment, what we end up with is an annual return of 40%. Now here's the cool part. You don't actually need any complicated spreadsheet for this. Because of the simplifying assumptions we made, the model really collapses into one line of math, which is that the annual return is equal to the annual cash flow divided by the purchase price. You can check that against the spreadsheet and the calculations we did earlier. $280,000, which is the annual cash flow, divided by the $700,000 purchase price, gives us about 40%. And if you flip that formula around, you can actually solve for the purchase price that gets a buyer their target return. The purchase price in this case will equal to the annual cash flow divided by the target return. So given all of that, the question naturally becomes, what kind of return does a small business buyer actually need in order to make the purchase worth their while? In my experience, and this is consistent with how buyers and their lenders will assess these transactions, the typical return that buyers target for these types of small business deals is anywhere between 25 to 45% per year. Now that obviously sounds high, but remember that their alternative is just to park it in an investment account and earn something like 8% per year without doing very much or taking on a huge amount of risk. A 25% return is usually more relevant for a stronger, more stable business, perhaps one with contracted, recurring revenue, a real team, and less dependence on the owner. On the other hand, a 45% return is probably more appropriate for a riskier one, perhaps a smaller one with more owner dependence, perhaps with volatile earnings and some customer concentration. And buyers will kind of make their own assessments of the risk associated with the business in order to come up with their target return. Now, having said that, let's run both ends of these bookends on the landscaping company that we just talked about. If we assume that the buyer is viewing the landscaping company as a relatively low-risk investment and is willing to earn a 25% return on their investment, we have $280,000 divided by 0.25, which gives us $1.12 million. If instead that we think that the buyer views the company as higher risk and requires closer to a 45% return, what we have is $280,000, which is again the company's annual cash flow adjusted for capex divided by 0.45, which gives us $620,000. So there are our bookends. Depending on the relative risk associated with the business, the returns approach says that a rational buyer might pay anywhere between $620,000 and $1.12 million for the business. Now remember that the market approach in part 1 valued this business at $750,000 based on what similar businesses had sold for. Notice that $750,000 sits very comfortably within our bookends of $620,000 to $1.12 million. That's an important check. It tells us that the market price that we're seeing is one that a buyer can rationally pay. In fact, $750,000 would earn a buyer about a 37% return, which is right in the middle of our 25 to 45% that buyers actually need. Now imagine that we had instead priced this business at $1.5 million. That's outside of these bookends, and at that price, the buyer's return drops to somewhere around 19%. Unless the business was exceptionally high quality, or in other words, low risk, that's not a return that's likely going to work for most buyers in the small business space. So in reality, we're not actually using the returns approach to land on a single number. We're instead using it to pressure test our asking price from the buyer's perspective and establish a reasonable asking range in which a deal could reasonably happen. Now here's the payoff that I promised you in the hook of this video. If we take these two target returns and we flip them into multiples, what we find is that 1 divided by 45% is about 2.2 times cash flow, and 1 divided by 25% is exactly 4 times cash flow. That's where the 2 to 4 times comes from. The rule of thumb that everyone talks about isn't really just a coincidence, it's sort of the mathematical consequence of buyers typically looking for a 25 to 45% return to make owning and buying a small business worth the risk and the work. Riskier businesses will price closer towards 2 times, whereas stronger businesses will price towards 4 times. So hopefully that ties the entire valuation series together. Now specifically for this video, I want to talk a little bit about why it should matter to you as a seller. There are 3 reasons that I think this is important. First, the returns approach gives you a great reality check on your asking price. You can run this math on your own business in about 2 minutes if you take the SDE, you subtract your annual capital expenditure, and then you divide that by your asking price. If the result comes out to below 25%, that's a sign that most buyers, and probably their lenders as well, are going to pass on purchasing your business at that price. Second, understanding the returns approach can help you justify a higher price for your business. If your business is genuinely lower risk, it has contracted recurring revenue, it has a seasoned manager in place, it has a diversified customer base, etc., then you know that buyers will likely accept a return towards the lower end of that range, towards the 25% end. In that case, the exact same cash flow supports a meaningfully higher asking price. That's the difference between a business valued at 2 times earnings and a business valued at 4 times earnings. It's also the reason why a lot of the work you do in advance to de-risk your business before you put it up for sale will pay for itself many times over. Third and finally, the returns approach really helps you understand how a buyer is thinking at the negotiating table. When a buyer pushes back on your asking price, they're usually not trying to be just difficult. It's more likely that the math isn't clearing the return that they need. If you understand the model, you can sort of negotiate the inputs to their calculations. You can talk about the risk story, the add backs, and the deal structure, instead of just arguing back and forth about a price. And that's exactly why when I value a business at Sundance, I don't really rely on just a single method. I pull actual transaction data from my databases, I run the returns model, and then I lay everything side by side to see where there's overlap. When the values across different valuation methods start to converge, you can start to price the business with a little bit more confidence. So let's quickly wrap up the full valuation series. In part 1, we talked about the market approach, which looks at what other similar businesses have recently sold for. For most small businesses, this approach does all the heavy lifting. In part 2, we discussed the income approach. Now, the income approach assesses a business's value based on the present value of its future free cash flows. This is a method that's less commonly used in smaller businesses, but it really is the theory that underpins every valuation method. In part 3, we went through the asset approach. This is based on the sum of the values of individual assets that are owned by the business. This approach typically gives you a floor for the value of your business, as it often discounts or overlooks its value as a going concern or an operating entity. And finally, in this video, which is part 4, we went through the returns approach, which gives us insight into how buyers are really thinking about the purchase price. This approach gives us a valuation range based on the prices at which buyers can reasonably pay for the business and still earn a reasonable return on their investment. Understanding all 4 of these valuation methods will help you have much better conversations with business brokers, lenders, and most importantly, with buyers on the other side of the table. If you haven't watched the rest of the series, I'll include a link to the full playlist here. And in my next video, I'm going to pull out a real tax return and show you how to calculate SDE from it line by line. SDE, if you recall, is the number that's at the foundation of almost everything we do in this series, so make sure you hit subscribe so you don't miss it. And if you're seriously thinking about selling and want to talk through your specific situation, including what the buyer's return math looks like at your target price, I offer a free, no-obligation consultation. I'll include a link to that in the description below. Again, I'm Ed from Sundance Financial, and I'll see you in the next video.